Welcome back, traders and investors. We have Rick Ackerman on the line. He's a technical forecaster and author of Rick's Picks. Rick, how you doing today?
Good. Thanks for inviting me on.
Could you give us a little bit of your education and market background?
Well, I actually came out of a newspaper background. I was a newspaper editor for 7 years, but I moved out to California and took a seat on the Pacific Exchange where I was an options market maker for about a dozen years. And I've been trading since, also putting out a service that's geared to traders.
And what did you do in the newspaper industry?
I was a reporter and then an editor for the Atlantic City Press, and I kind of came back to it roundabout, writing on the markets for Barron's, and I did a column for the San Francisco Sunday Examiner for a few years.
And then you went down to the trading floor at the Coast. How much of a change was that?
It was amazing. I came out of a newsroom background where the only noise was typewriters, and I got interested in the options exchange by visiting when I visited a friend who worked on the Philadelphia exchange, and it just seemed like the kind of high energy place where I wanted to be at that point in my life.
Yeah, and now you've have to adapt to screen trading. Talk about that process a little bit.
Yeah, for sure. I did a column for Barron's actually that said that when all the action moved upstairs, the last vestige of honesty in the game would be lost. I think you really need people shouting in each other's faces in an open outcry auction that goes back, hundreds of years to affect an honest trade. But you never know what's happening electronically upstairs anymore.
Yeah, that's a good point. So let's get to your current outlook on the market, and you've have found some rally targets in some big indexes here: the E-mini, the S&P, the E-mini, Nasdaq. We're getting close up to all-time highs here. Are you taking a cautious perspective?
Well, like a lot of perma bears, I've been forecasting the mother of all tops since about the 1980s. But fortunately, I have a system that keeps me honest and objective. So I do feel, as your last guest does or did, that we're in a broad topping pattern here, and I do have some higher targets. The E-mini S&Ps, for one, could go all the way up to 2054. Uh, so I basically work with levels, and I'm generally pretty accurate in forecasting swing points, and we at least get a trade. And I like to get short at these targets, and we can usually make a few bucks if we get the reaction we're looking for. And one of these days, it's possible to hit a home run. But typically, for my subscribers, I use vertical spreads that we try to leg into. So if we get to a targeted rally top in, let's say, the diamonds, we will establish a position by buying a put option that is well out of the money. I usually look for options that are priced under $1, and if I get the reaction that I'm looking for, a little down move from the target, we'll right away spread off the option so that we've essentially got a cost-free vertical.
Okay, and you gave that 2054 target. What was the time frame on that?
I would say over the next 3 weeks, perhaps,
3
and
weeks. Wow.
yeah, and I've had a target in the Dow for some time at 17,622, and it's really survived my own doubts. You see the market fall. We've seen it fall pretty hard over the last several months on occasion, but the declines have been really swoons. The market came roaring back, and that's very typical for a bull market. But so you tend to doubt these pie in the sky targets. My worldview is really perma-bearish. I've been a hardcore deflationist for many years, and I would say that the idea of deflation colors my trading and economic decisions more than anything else.
Why don't you explain that in your view of deflation and why that's going to be bad for the markets?
Well, not bad for all markets because probably the only no-brainer I can think of right now to put your money in would be long-term Treasury strips, and I'll explain why in a bit. But I see the essentially quadrillion-dollar derivatives market as unactualized deflation. And the Fed, in loosening, has been trying to fight the implosion of that potential deflationary juggernaut. And it's very deceptive because, you look around and people say, geez, what are you talking about deflation? We've got the price of everything is going up. But I think that those items are anomalous. We see an increase in groceries simply because there's a drought in California, and an increase in the cost of college tuition simply because it's being fed at this point by federal loans that are up to, they total about $1.4 trillion now. So in each instance where we've had price increases that people would call inflationary, I say that the much, much bigger picture, the big enchilada, is pure unactualized deflation. And with respect to Treasury strips, if you've been in them for the last 5 or 6 years, you'd have a profit in 5 of those 6 years. You'd have gains on the order of 20% plus. And right now, for instance, if we get the test of the essentially the 2012 lows in the 30-year and the 10-year note, you could have total returns within a year of approaching 41%, I calculated, on that 2044 Treasury strip. So I think it's a great play, and it's really one that's very opposite the crowd. And the reason they've been wrong for so many years is because the focus is on deflation, where it should really be on the deflation.
Okay, and you like to use the VIX as an indicator, and it's closing in on a potential bear market low. I mean, there's just been no volatility really in this market. You haven't on a few separate occasions. We had it one time last week. How are you identifying this potential bear market low in the VIX?
Well, I've had a target out for some time at 25.43 on the VXX. That's an index that tracks S&P 500 short-term volatility. And we've had some blips, and I've had people in my chat room say, geez, it looks like the market's about to erupt. But of course, as long as the broad average is slogged steadily higher, volatility tends to decline. So we've really come down from the low to mid-30s. Most recently in VXX, we're trading today, let's see, at 27.24. My target is 25 point, I believe it's 43. So I think when we get there, I don't have any doubt that we're going to get an upturn, a real skew in volatility at that point. And you have to ask yourself, what would that mean? And the logical inference is that stocks are going to be coming down.
And what do you think the driver for that will be? I mean, earnings seem to be pretty good so far this earnings season. You have a lot of things going on internationally with Israel and Hamas, and that's not really shaking up the market. What do you think? I mean, QE is supposed to come to the end. What's going to be the catalyst to finally drive the VIX higher?
I think we'll only know when the Dow has fallen 5,000 points. I tend to see the tail wagging the dog, and I think that where the market goes really colors our perceptions of the news. So with the Dow at record highs right now, you look at all the mess that's going on in the geopolitical world, and you think, well, we're somehow coping. But I believe that it's the Dow being at those heights that makes it possible for us to cope psychologically with the geopolitical mess. So if you bring the Dow down pretty hard, everything that we're coping with now is going to look very powerfully destructive, and we won't be coping so well. So I just see the market turning down for no apparent reason, at least initially. But if you needed a reason, I think that this revision in GDP to negative 2.9%
Right.
is an interesting variable because, we've never had a down quarter of that magnitude that was not within a recession.
Blame it on the weather, right? Right.
Well, everybody was looking for that bounce from the terrible winter, but you can see in the numbers that Kohl's and Target and Walmart are reporting out that quite a bit of the consumer economy is not bouncing back at all, and obviously it's at the low end right now. I mentioned in a commentary the other day that $10,000 wristwatches are flying off the shelves. So at the high end, the rich and the super rich haven't felt any trouble at all, but it's really starting to draw down the consumer economy at the low to middle rungs.
Okay, you have a long-term perspective and a short-term perspective on the markets. Could you just give a few tips for our investors and traders, that perhaps that are doing some, intermediate or shorter-term trading? Just some of the rules or a golden rule that you've learned to adapt during your trading career.
One of the most important is to take partial profit early on in a trade. When you take a little of the house's money off the table, it really improves your psychological outlook. I think you're in harmony with the markets. If you're more relaxed, you tend to make better trading decisions. So I do use a style of trading called camouflage, where we essentially look at big patterns and instead of going opposite them at the swing highs and lows, we look for the first sign of the turn in charts of very small degree, the 1 or 2 or 3 minute chart. So if you're expecting the turn there, you can essentially jump on a trade using a stop loss that is commensurately small with that little pattern. So that's what we do, and it makes it a lot easier to get in and out. And when you bail out of a trade, when it's been so easy to get into it, it's easy to get in again, so you don't tend to stick with the loser. So I would say more than anything, the idea of managing your risk by taking a partial profit early is good. And I always do the trade with a 1 to 3 risk-reward relationship from beginning to end, so that if I'm shorting against a rally with let's say, a 6-cent stop loss, I need 18 cents going my way before I take a partial profit. So I'm always using that 1 to 3 risk-reward relationship, and maybe sometimes a little too rigidly. My subscribers tend to out-trade me on many of my own recommendations because they loosen up just a little bit.
No, no, that's a common theme that we've heard with many of the different traders, investors that we've had on. So, thanks a lot, Rick Ackerman, technical forecaster and author of Rick's Picks, giving his outlooks on the market. Rick, thanks for coming on this morning. We'd like to have you on again.
Thanks much for letting me join you.
Okay, thanks, Rick.